Assalamualaikum and hi, my name is Amera Nasirah binti Mat Nasir. My UiTM ID is 2021112991 and I am from JBA2423C. Today I would like to present about capital structures. So, what is capital structure? Capital structure is a part in financial structure that only include long-term source of fund. It is a combination of a company's long-term source, which include debt and equity such as preferred shares, equity shares, debentures, return earning, and other long-term. This clearly shows that the capital structure can be constructed as capital structure equals long-term debt plus preferred shares plus net worth. The continuance of the company's financial stability and risk of insolvency are heavily depend on the source of fund. This makes capital structure important because it will support the company's growth. Next, how to determine optimal capital structure. Optimal capital structure is a combination of debt and equity that has the function of minimizing the weighted average cost of capital or WACC while maximizing its market value. The optimal capital structure will involve some mixture of lower cost of debt and adequate amount of higher cost equity fund to lessen the possibility of not able to pay off the debt, because we know that the large amount of debt can have the risk of getting bankruptcy, which will drop the business in market value. So, to calculate the optimal capital structure, we'll roughly calculate by calculating those debt and equity. This aims to minimize the WACC and maximizing the market value. The higher the present value of a company's future cash flow, the lower its cost of capital is. Hence, the main goal of every company's financial department are by being capable of determining the ideal capital structure. A company with a great financial profile will try to increase the capital by consuming more debt than equity, because naturally seen as a great news as this identified as debt signaling. And when a company decides to raise too much capital during one time, the preferred stock, common equity, and cost of debt will begin to rise, and this will lead to the rise of marginal cost of capital. To measure how risky a company are, the potential equity investor will take a look at the debt to debt equity ratio. This also to see how trend line changing, and the ratio commonly will be plotted on a trend line. Other than that, they will also make comparison with the same ratio with other business within the similar industry. This is done to see if the company's management is using unexpectedly high level of debt. Thinking like a bank is also another technique to figure out the optimal debt to equity ratio. Management may also obtain feedback from the investment community on how its capital structure is perceived in the marketplace. Next is factors that affect capital structure and capital structure decision. The first factor is financial flexibility. Financial flexibility means that the company is able to do business like usual and stable in any situation. Business need to be able to handle the business during downturn period regardless of the thriving business and the economy. The business need to be always ready despite the bad times. So when they facing a slowdown period, it's better for a company with a low debt compared to higher debt. One of the usual mistakes that most of the companies do is raising too much capital through debt without realizing the ability to pay it back. As a result, they fail to pay back the debt during those bad times and lead to the investor losing their interest and confidence. Second is business risk. For every business, there will always be a risk. For example, a company that owns a utility business will have less risk on seasonal fluctuation compared to business on fashion industry. Therefore, every business in fashion industry will usually more focus on the optimal debt ratio, because investor will feel better and secure if the company is having lower debt asset ratio. If business risk at the lower side or having less risk, then it can raise more by issuing debt security. Third is operating cash flow. Fixed costs also may impact the capital structure. If company use a very high amount of fixed cost in the total cost, it can increase the inconsistency of future earnings. The operating profit should not cover too much on interest payment. It must be enough to meet the routine of obligation and expenditure. The fourth factor is nature of business. The profit margin for firm will be at risk if the company operates in a non-competitive industry or market. It could suffer loss. In this case, the company should use debt in small proportions so that if there is a loss in the year, the interest payment burden will not affect the business adversely. And lastly, management style. Management style refer on how the company is doing the business, whether aggressive or conservative. A management that aggressive is not scared of taking risks. Therefore, more debt is not their main issue. In contrast, conservative approach would prefer a lower risk even it is meant to gain a lower return. The most crucial thing is for investment to understand and evaluate the company's capital structure. There are 4 things that the company needed, which is operation, organic growth, acquisition, and returning cash to the shareholders. Management should decide the least amount of liquidity that required to finance all these 4. The need of keeping and prepare certain level of liquidity on the basis to what-if situation. Next, to identify the company's credit rating, whether it's good enough to guarantee instant access to fund. If the rating shows a poor result, the company needs to make an adequate adjustment in the capital structure. And lastly, to create a clear decision-making framework. This will help the company in guiding the management when dealing with all sorts of liquidity problem and scenario. Next is financial distress. So, what is financial distress? Financial distress is a state that refers to the inability for a company or individual to generate their revenue or income. When revenue or income is not able to meet its financial obligation for their organization or individual, is the definition of financial distress. So, in corporate finance, financial distress is a term that we use to describe a condition when any promise that were made to creditors are broken or honored with difficulty. High fixed costs, a large degree of illiquid assets, having no saving, poor budgeting, poor money management is example of the cause that can lead to have financial distress. Companies that experience financial distress have difficulty to secure a new financing. There will be a time where financial distress no longer can be resolved because there are too many obligations and cannot be repaid. If this happens, bankruptcy may be the only option left. Next is integration of tax effect and financial cost distress. Financial distress is related to companies' costs, and these are identified as financial cost distress. It is a cost that arises from bankruptcy or distorted business decision before the bankruptcy. It is a situation where companies find difficulty to pay back on the obligation. Distress cost is a cost that firms having when they are in a financial distress, and it is usually beyond the cost of doing business. Distress cost can lead to the need of selling asset fast and at a hard to meet immediate obligation. There are 2 categories of distress cost, namely as ex ante and post ante. Ex ante is cost before event and post ante is cost after the event. To know about the financial cost distress, we need to understand about the bankruptcy risk and the bankruptcy cost. It is true that the option of becoming bankrupt has a bad effect on the value of the firm, yet bankruptcy risk does not lower the value. To be exact, it is the cost associated with bankruptcy. Okay, according to the financial researcher and some experts, they were correct in assuming that the cost of bankruptcy could reduce the firm's overall value. Now, as for the effect of the debt financing, the possibility of distress is high when the present value of distress cost is maximum. This means every time the debt value is increased, it will increase the present value of this cost. It will eventually match the growth in the present value of tax shield. Bankruptcy will increase quickly as a result of the tax shield, lowering the firm's worth. The graph shows that the integration of tax effect and the financial cost distress. There is a trade-off between the tax advantage of debt and the cost of financial distress. As shown in this graph, when the present value of financial distress cost is increased, So does the present value of that ship on deck. As a result, we can see how these two are integrated with each other. Agency cost is the cost that resulted from the conflict that happened between the shareholder and the managers of the company. Any disagreement is also called as an agency cost. The shareholder has to bear some cost when the manager of the company diverges from the interest of shareholder for any reason. Manager usually make choice that only advantage them. Free cash flow provide this chance to them. Free cash flow hypothesis says that growth in dividend should be an advantage to stockholder by reducing the ability to managers to pursue wasteful activities. Hypothesis also claim that as a high level of debt will reduce the ability of manager to pursue wasteful activity more effectively than increase in dividend. Next, for pecking order theory, there are two rules in pecking order theory, which is issue internal financing first, issuing debt next, and new equity as last options. Firms prefer to issue debt more than equity if internal financing is insufficient. The pecking order theory comes from the concept of asymmetric information, or known as information failure. This is a type of information that happens when some party has more or better information from another party. External users usually demand for a higher return to compensate for the information asymmetry to counter against the risk that they are holding. The company will always use retained earnings financing first because it will minimize the information asymmetry because it comes directly from the company, unlike debt and equity, because this is an external financing. If the retained earning is insufficient, then managers prefer debt over equity for external financing because the cost of debt is lower than the cost of equity. Furthermore, the pecking order theory is at odds with the trade-off theory, which is there is no target DE ratio using less debt and companies like financial slack. The evidence of the pecking order theory can be in size, tangible assets, profitability, and market to book. And usually the small firm tends to have a lower debt ratio compared to larger firms. The signaling theory were taken from the information asymmetry between the shareholder and the company's management. According to the Rose 1977, he said that the choice of capital structure of a company is a signaling information to the market, and usually the board will believe that the investment is profitable when company issue debt because it signals as an undervalued stock. If the management believes that the company is undervalued, debt will be issued first, followed by equity. On the other hand, when management believes that the company is overvalued, they will be issued equity first. A manager who incurs more debt than necessary in order to fool investors will pay the price in the long run. And that's all from me. Thank you.